All right, what's happening, people? In today's video, I'm going to show you how you can prepare to sell your business with using a C corporation. So before we kind of jump into the actual structure here, we just want to talk a little bit about the options you could possibly have if you had a business, right? So if you are a single member individual, you could have a sole proprietorship. This is what, a lot of people have right now, right? When they start a business, they have very little income. They just report this to their social. They don't really have anything else going on. And then they get into the corporate structure, right? Which is the limited liability company. And within the limited liability company, there are a couple options, right? There's disregarded, which is just the LLC flows through. You have a 1065 partnership. This is also a flow through entity, which basically splits into multiple partners. So let's say there's three of you. You maybe have a three-way partnership. The partnership pays no tax, but it just formalizes how you guys work together. Then you have what a lot of people use right now, a lot of small businesses, the S corporation for small business corporation. And then you have the classic C corporation. Now, in general, the majority of people are going to use the three things on the left here. And the reason that they're going to use these three, that would be the disregarded entity, the partnership, and the S corp, is these are all considered to be flow through. Okay. And basically what that means is that all of this income eventually flows to you personally, right? So you don't pay any tax at the corporate level. In the S corporation, you get a W-2 wage and you get a K-1. In the partnership, all the partners get a K-1, and the disregarded entity, this flows to the personal return, typically on a Schedule C, okay? And most people use one of these options, and they are great options for sure on the tax front, but what you end up running into is that when you go to sell, you a lot of times have a really, really hard time managing the tax. And so in comes the C corporation. This is like your Fortune 500 type companies. Typically, these have more than 100 plus shareholders, right? Most of the time, and they're publicly traded. Most of them, not all of them, but most of them. Now, there's a new provision under the Big Beautiful Bill, and it has to do with qualified small business stock sales, Section 1202. In the past, what the rule has been is that the company had to be under $50 million, and you could get the first $10 million on sale tax-free by selling shares of the C corporation. Now, this has recently, as part of the Big Beautiful Bill, been moved up to $15 million in tax-free, and I believe $75 million on the asset front. And so this is really interesting because if you were to start a business and sell using the C corporation, you could get $15 million tax-free. And since most people are going to build a business and want to sell it at some point, this can be a really efficient structure, right? Because you're going to get a bunch of money in retirement, kind of like a Roth IRA or something like that, but it's going to be totally tax-free if you use 1202. Now, one other provision that changed recently, which is kind of interesting, is you used to have a 5-year hold, and now it is a 3-year hold. And because it shortened this up, it allows, there's like a pretty good opportunity right now to have small business owners that are within, let's say, 5 to 8 years of retirement that in theory could shift from an S corp to maybe a C, or maybe they're a partnership right now and they want to reorganize into a C or something like this. And this would be very, very, very helpful because it allows them, again, if they can hold it for 3 years, then you can be in a spot where you could have tax-free sale of a business. And you see online that Cody Sanchez and a bunch of these other people, they're all talking about the baby boomers, right? And what are the baby boomers doing right now? Most of them have assets. Most of them have limited debt. And most of them also have a business that is worth somewhere between $2 and $10 million. And when I say most of them, I'm talking about the people who own a business, right? Not the people who don't own a business. A lot of these businesses are worth 2 to 10 million and are trading at 2 to 4x EBITDA. So imagine this scenario here, right? The scenario is that somebody is, let's just say they have a business that does 2 million a year right now in profit, which would not be unheard of. And that, let's just say, trades at 3x. So their business is worth $6 million when they sell it. In their current scenario, they might, depending on their situation between their ordinary income and some of the other taxes, on this $6 million, they might pay $1.2 to $1.5 million in tax, leaving them with something like $4.5 million. And you say, okay, well, that's pretty good. They get $4.5 million. But what if you were to reorganize the business so that this $6 million leaves you with $6 million? I think this trade here, this $1.5 million trade, is worth the planning exercise for most people who have good sellable businesses. And so if you are somebody who is going through a process of considering selling in the next 3 to 5 years, you might want to consider this as a real strategy for yourself. And if you think you want to sell, you got to consider that this is a legitimate option for you that gets you tax-free wealth. And if you structure this properly, you will be in a much better position long term. Now, the last piece I will point out for most of you. In a C corporation, there are generally 3 ways to take money out. There's a wage, there's a dividend, and then there's loans. So the C corporation pays 21% flat tax on the first dollar and the last dollar, all the way across. You get all your deductions just like normal business. But when you take money out, you got to pay the 21% first, and then you can take a dividend, or you pay the 21% first, and then you can issue a shareholder loan. Now remember, where the abuse comes in from a lot of people is they take shareholder loans that are unlawful, right? And what do I mean by this? They take a loan with no intention of paying it back, which is really a disguised dividend. And dividends get taxed at the dividend tax rate, which varies. So keep in mind that there are some downsides to the C corporation. However, there are real scenarios where it makes sense to be able to have maybe some short-term lending, taking out some wages and some dividends if you can have enough expenses inside the C corporation to keep your costs low. So if you're somebody who's selling a business, it might be worthwhile talking to your tax pro about converting to a C corporation.